Thanks. Hello, and welcome to this webinar on rethinking guarantees in development finance. I'm Hans-Peter Lankes, the Managing Director at ODI Global, a think tank based in London, and we have the privilege of hosting this event. Just a few words of introduction, and let me be very brief because we have a packed program. There have been significant efforts over the past few years to scale up the lending capacity of the development finance system, both by stretching balance sheets and by mobilizing private capital. That's been a running theme for several years now. And in that context, guarantees have been quite prominent. There's a perceived underutilization of the guarantee instrument by the multilateral development banks in their project finance. And separately, guarantees or portfolio guarantees were seen as possible ways of lowering capital charges on MDB balance sheets and creating more headroom for MDBs to lend and operate. Now, having spent much of my own career in development finance institutions, I'm well aware of the difficulty of scaling up guarantees. Actually, it's interesting to note that in the World Bank Articles of Agreement from 1943 or 44, the first instrument in the lists, in Article 3, of the instruments that the World Bank has at its disposal is guarantees. So it says the bank may guarantee, participate in, or make loans to any member. And guarantees were important in the early days of the World Bank, but by the 2010s or so, guarantees had become very rare. A key issue is that incentives internally are often not really aligned for the use of the guarantee instrument in both the banks and often in borrower countries as well. And there's also questions around what value they add compared with funded loans, especially on the sovereign side. The World Bank Group has now, after these reform discussions of the past few years, it has pulled together its guarantee offer on a common platform for greater punch. And there are new guarantee platforms under consideration, for instance, for Africa, and we may hear about that. But there has been limited consideration of specialist guarantee companies, of how they perform, how sustainably, whether and how they can offer solutions at scale, and how they can add value relative to guarantees deployed directly from public balance sheets or public bank balance sheets. These questions are addressed in a new report that was authored by William Perrodin, the Managing Director of Risk Control Limited. That report was commissioned by the Foreign, Commonwealth and Development Office's Mobilist program and by the Swiss State Secretariat for Economic Affairs. Let me take you very briefly through our program today. We will start with a scene-setting intervention by Ross Ferguson, a Senior Private Sector Advisor at the FCDO, the UK Foreign Office and Commonwealth and Development Office. Then William will present the report's key insights. And that's followed by interventions building on William by leaders of three specialist guarantee companies, Chinua Azubike of IntraCredit, Lasita Pereira of the Green Guarantee Company, and Dinesh Srishankar of the Private Infrastructure Development Group. After these initial presentations, we will then turn to our panel, and they will examine the case for investing in guarantee companies operating in emerging and developing markets, the constraints these entities face, and how donor governments and development finance institutions should approach their involvement. We have a fantastic lineup of panelists with Hassatu Diop Nsele of the African Development Bank Group, with Ed Mountfield of the Multilateral Investment Guarantee Agency, and Katrin Mühlbronner of Moody's Investors Service. Now, we have a compressed program, as I've already said, and we'll have to run the show with military precision. And if we're all disciplined, we will have around half an hour at the end for a general discussion. Ross, with that, I hand it over to you, please.
Thank you, Hans-Peter, and I will note the instructions on discipline, so I'll be very brief and quick because we've got a great set of panelists. So thank you very much for your opening remarks, to ODI for hosting this event today, to William and the team at Risk Control for the report. We're really looking forward to hearing from you, William, as we are to a great group of panelists. And finally, on behalf of FCDO, thanks to everybody who's online attending the event today. It's hugely appreciated, and your interest is well noted. I am a private sector advisor with FCDO. I'm also the lead on the Mobilist program, which is the FCDO's public market investment program. And alongside our investments, we have a research arm. And indeed, this is the genesis of the report today. It's funded by Mobilist Research with our partners from Switzerland, SECO. So we're extremely grateful to SECO for co-funding this opportunity with us. As many of you will already know, the FCDO has a wide range of interventions and interests in the guarantee as a mechanism for mobilizing capital. Not only from our own balance sheet do we issue guarantees, or through the multilateral development banks and our support for MEGA, and also through the PIDGE group, and you will hear from our friends at Guaranco today. But Mobilist itself has supported guarantee initiatives, both in terms of the Green Guarantee Company, which is a hard currency, commercially predicated guarantee company focusing on scale. And I'm sure some of you will have seen we were delighted to support the listing of InfraCredit Nigeria earlier last year, and actually exited our holding to pension funds in Nigeria in the autumn. So Mobilist, because we are focused on capital markets and public markets in particular, we are focused on scale. And this was a really important piece of research for us. And I hope for everyone on this call. And William, I think, has done a terrific job of assessing the landscape, giving us some idea of what has worked and what hasn't, particularly from the monoline insurers in the US, who are themselves focused on scale. And I think this has important lessons for the Mobilist program, and indeed for FCDO policy when we're thinking about mobilizing capital at scale. So I will stop there. I will look forward to handing over to William, who I believe is going to take us through the key learnings in the report. My sincere thanks again to everyone who's on this call. Thank you.
Thank you, Ross. And over to you, William. William, I believe you're muted.
Yeah, I'm just sharing my screen.
Very good.
Great, thanks very much. I hope you can see my screen. Yes. So this paper is by myself and several members of my team. There's a lot of work gone into it. 5 of us probably have worked on it intensively over quite a few months. Our brief was to look at the lessons you could learn from the monolines, particularly with an emphasis on scaling guarantee activities. So I'm going to take you through that with the following slides. I will pick up particular points because I have little time, so I want to be rather disciplined in sticking to the time. So I will just pick up particular points and emphasize them to give you the main ideas of what we've been doing. So I'm going to talk slightly about why guarantees and guarantee funds, lessons from the monolines, and then talk a little about the guarantee funds in EMDEs that I'm sure are the main interest for the people on the call. So those guarantee companies, there's a set of them that donor governments have invested in. Some are quite well established, some are new. They invest in different things. So some have an infrastructure focus, others SME, others corporate bonds more generally. And some of them, many of them, have a local currency um, emphasis. So they're writing guarantees denominated in local currency. So that's a bit the landscape or the background that we're interested in. I just felt I should say something about guarantees in general. There are so many studies and presentations about guarantees. Our paper is not, in a sense, about guarantees, it's about the organizations that offer them. So, what we're interested in is not the instrument directly, but it's the entities, the financial organizations that offer them. So that's really important that you understand that. But nevertheless, on guarantees, I just wanted to say that guarantees are not radically better in any sense than say loans. But what the major advantage they have is, if you've ever read Adam Smith's Wealth of Nations, the division of labor. So manufacturers of nails in 18th century Scotland divided their activities between in a rather precise way and got economies got division of labor advantages from that. And that's what you see with guarantees. Guarantees permit you to separate the raising of money and the bearing of credit risk. So that has big advantages in specific cases. So it has big advantages if the guarantor has superior underwriting capabilities. So if they're specialists, if they know the local market or they know the product really well. They also have advantages potentially when there's a hard currency versus local currency. So in some cases, yeah, guarantees reduce local currency risk in some sense because the currency risk is only borne when a claim is made. And so they are much less subject to currency risk than lending in a local currency. And then a lot of the commercial guarantor industry revolves around either different regulatory treatment or possibilities of diversification that, a general insurer can take on some credit risk and it hardly affects their overall balance sheet. So those are why guarantees are interesting. So why guarantee funds? Why have these separate capitalized entities? And I know there are people from MDBs on the call, so, this is not to do with any particular institution, but I just thought I would say that if you talk privately to, I mean, several large MDB staff members I've talked to, they they may not be positive about guarantees because often they're focused on their own superior ability to raise money through bond issues. If they are keen on guarantees, then they'll often say, oh, well, just give us the capital. Why should you do it off a separate balance sheet? Wouldn't it be more diversified to have that with us? So there are arguments, I think, important arguments for having specialist guarantee companies. One is all about this specialist knowledge. That's one of the things I'm going to mention in a moment with the monolites. They really got into the products that they were working on. They were able to provide for infrastructure guarantees, they had much more knowledge than the investors from whom they were raising the money or from whom the money was ultimately coming. The second big argument is to do with the rating of the balance sheet. So when you put a guarantee on something, the beneficiary maybe doesn't care whether it's an A or a triple A. So in that case, you can run a guarantee operation off a lower rating and have higher leverage. the rating agencies will allow you to operate on a larger scale. On the other hand, the beneficiaries of the guarantee may be really bothered about high rating. So if you're an international bank, you probably want a double A rating from a guarantor. So it's very much about who are the beneficiaries, what are the rating constraints. And so it's not so obvious that running guarantee operations from a triple A balance sheet is sensible in all circumstances. What do we get from the monolines? I mean, what do we learn from the monolines? So I talked to a lot of monoline, former and current monoline staff in doing this paper. Several of them said to me after I showed them an initial draft, they said to me, "Oh, you're terribly hard on the monolines." In a sense, I was hard on the monolines because I knew that I would have an audience like you guys who are naturally suspicious of the monolines. It's well known that most of the monolines failed in the great financial crisis. On the other hand, no monoline truly failed in the sense of defaulting. Their insurance contracts were basically, met. They renegotiated some contracts they had with investment banks, but in their view, there was fraud involved, or deviation from the terms of their insurance contracts. So I'm slightly hard on the monolines, but one should view them not as necessarily, in general, kind of bad outcome. And in particular, in two of their three main lines of business, they were strikingly successful and contributed a lot. One was in US municipal bonds, where they provided cover exploiting tax and informational advantages, but they made substantial contributions to that industry or to that financing over a long period. And then the other, which is particularly relevant for this current audience, is in international infrastructure. And what they did there is they provided insurance for project finance debt for mostly developed economy governments that didn't want to encumber their own balance sheets. Ring any bells? Lots of emerging market governments with high levels of debt don't want to encumber their balance sheets. So, what the monolines did in infrastructure is highly relevant or interesting if you look at what they did. And that's, in a way, I think, why FCDO kind of identified this as an interesting topic. And it's something that we're trying to bring out in this study. What did they do then? Well, they used an insurer business model with specialist underwriting teams. And they were brought down ultimately by the securitization exposures that they had, or some of them were. But in their other lines, they made, they were quite successful, very successful. And the main survivor of all of it is still a successful, energetically making profits. Were highly profitable in the years after the crisis, and they were protected by a couple of decisions they made not to engage in fully in securitized or structured product guarantees. After the crisis, Assured Guarantee took over parts of other businesses, and and another thing which is really interesting is what happened to the staff of some of the other monolines. So some of the monolines were frozen and sat on their hands while the books ran off. But Allianz, the asset manager, hired a team of people from MBIA who then set up debt funds, private debt funds, and those funds created a new industry, really, or pretty much. I think that's fair to say. They created a new asset class um, using the expertise that the monoline staff had had. It took a while, but then ultimately other asset managers and investment banks acquired some of that expertise. And so there was a kind of product cycle there. But the the expertise heavy approach you can sort of see in the way that that group of people and the way that former monoline staff spread out into the asset management industry. Um, so that's a bit of the story of the monolines. I wanted to emphasize, I mean, this aspect that we are focused on here, uh, you know, the organizations that provide guarantees. These organizations are constrained mostly by their rating. Even the monolines, insurers, regulated insurers, were really constrained by their rating. And any consideration about scaling has to be done with, has to be achieved with very close regard to the ratings of the organizations. The insurer business model is a very structured, uh, disciplined business model. We have done financial models of a couple of major insurers, and so we've sort of um, very much kind of pushed our nose against the glass on this and done modeling of what lies under the hood of an insurer. And this is a kind of diagram showing you a bit. Top right, capital constraints, which may be ratings or regulations, but actually are primarily ratings. And then all of this mechanism, you could think of it, for creating a business. Um, we did in the paper a kind of analysis of assured guarantees rating and scenario analysis of how they might grow or how if things changed, what would happen to their rating, how also what would happen to their return on equity. So interestingly, we see them as fairly close, I mean, fairly optimized with their rating. Which a bit limits the scope to grow, but they're profitable, but they have some constraints on them. Now, thinking about these other funds, the MDE funds, what do we have there? I mean, this table just summarizes a group of these funds showing their ratings. A lot of them have local ratings or national ratings. A few of them have ratings from Moody's, Fitch, S&P, and a variation in those ratings. Most of them are highly rated on a national basis, but their international ratings suffer from sovereign caps. This then is a diagram showing you our kind of our view of a guaranteed company rating, a guaranteed company business model, simpler than the insurer business model, but still a kind of mechanism with moving parts, pricing, the volumes, the constraints on it all. And so we did similar analysis of this is all based on public data. So it may be that we've misunderstood aspects of it. And so don't think that I'm telling you anything private about Garanco or InfraCredit. This is our external, if you like, intelligent equity analyst view of these organizations. Constraints from the rating, some scope to grow, but challenges. The InfraCredit, the rating looks very solid indeed. They've benefited from currency changes, which has meant that they are capital rich, and their business is not really constrained by ratings. There are a couple of organizations that I just briefly wanted to mention, which their references, they're kind of successful, long established um, guarantee entities which are multilaterals. It's a different setup. They, to some extent, have different products, but this is where one would really like the guarantee companies to be going, with ultimately higher returns on equity, which you see here on the right, and then relatively high or quite high leverage ratios, which is permitted by breaking out into the reinsurance market. So structuring with a view to accessing reinsurance or risk syndication, I think is a crucial thing for the ultimate success of guarantee companies. My last slide is just to go over, some thoughts about, what should you do if you are a donor thinking of investing in a guarantee company? What would you expect of the business model presented to you? So, and this is highly, conditioned or influenced by what we've seen with the monolines. Focus on specific products and market niche, coherent business model with appropriate rating, conservative and carefully done underwriting, particularly in the early years, because it's like setting up a hedge fund. If you don't make returns in your first few years, you'll find it very difficult to get investors. So, to get reinsurance, you really need to have a success in your early years. Focus on risk management, use reinsurance as much as possible, price keenly because the demand for your services are price elastic, and then tightly control costs in order to permit tight pricing. Incentivize key staff, especially underwriters and business development. Focus on financial sustainability and barriers to entry. The investor information presentation from Assured Guarantee has lots of focus on the barriers to entry that limit their competition they face. That should be, that view should be high up in the business model. And then quality and commercial experience of leadership. ISIC and Atity that I mentioned earlier, which are really looking, successful, strong organizations, for some years performed less well, and then recently have performed really well. And so that is, really good commercial focused leadership. Okay, stop there.
Thank you very much, William, for a great report. Can you mute? Because we get an echo. Great. Yeah. Thanks for a great report, William. Really super original. This is, as I said, I've been in this business for a while. This is a very new perspective that you're offering. And so now we would want to build on that and hear from leaders of three specialist guarantee companies. So can I turn to you first, Dinesh? Dinesh Srishankar is the head of credit enhancement facilities at the private infrastructure development group, Pitch. Dinesh, we'd be interested in your perspective on the report's findings, and in particular, whether you could comment on the scalability of guarantee solutions, including those of Pitch.
Great, thank you, Hans. And thank you, William, as well for that. The report was very timely and valuable, actually, and a very interesting read. So thank you for that. So as a brief introduction, the Private Infrastructure Development Group has been active since 2002 in infrastructure in emerging markets, particularly Africa and Asia. And specifically in the guarantee space since 2005 via Garantco, which was one of the first emerging market-focused local currency credit guarantee platforms. And what Garantco does is issue on-demand, non-payment credit guarantees with the aim of mobilizing the private sector on the debt side into infrastructure. It can do guarantees for up to 20 years. Garantco is rated A1 by Moody's, AA- by Fitch. And it's really focused on the infrastructure space and infrastructure adjacent sectors. So in the context of scalability, I think it's important to take a step back and think about what are the demand and supply drivers for this product. And William, you highlight some of these in your report in the context of the monolines, and indeed they do apply it in the emerging markets as well, right? So the restrictions on banks being able to lend long term in the US apply in emerging markets, not only regulatory perspective, but other structural issues facing the market as well. Institutional investors in the 90s in the US and their lack of familiarity of infrastructure as an asset class applies today in the emerging market space as well. And on top of that, there's a significant financing gap when you consider the infrastructure need in these emerging economies over the next 10, 20 years. So there's a strong demand side. Now, on the supply side, think about the liquidity that can be mobilized through the use of a guarantee instrument. You need markets which have a reasonable depth in the domestic banking market, but also in the capital markets. And so these are the markets which has helped to sort of focus Garanko's activities where these different criteria are evident to allow it to scale. No, I want to make a point about scaling in emerging markets, I think because it is a little bit more tricky than in the developed markets. And the first point, which I'd say to many clients on many calls, is guarantees do not make unbankable projects bankable, right? A bad risk is a bad risk, and guarantors aren't there to take those risks. What guarantees do, what guarantee companies do, is take misallocated risks, misunderstood risks, and then through structuring and expertise are able to take those risks themselves. Now, the pipeline availability is key for scaling these businesses, and really mandate drives the pipeline. And at TD, ASIC, they have quite wide mandates relative to Garanko, which Garanko is really focused on infrastructure. When you're looking at including trade and shorter term transactions, your addressable universe is much wider. Also, when you're looking at the infrastructure space, the bankable transactions do get absorbed by the private sector on the local banking side on a shorter tenor basis, but that causes a tenor mismatch, but also by the DFIs and multilaterals from a hard currency perspective. So that means when those layers of transactions are gone, you need to have high origination effort as a guarantor to make sure you are originating and structuring good transactions that are going to have a good risk return profile for your business. There is some point to be made about developed markets having a longer track record in laws, regulations, and frameworks like recovery legislation, etc., which allowed the monolines to take much larger single concentration exposures than you may want to be comfortable taking in certain emerging market economies. But all of this really adds up to your emerging market operators in the guarantee space needing deep country, sector, and product expertise to ensure they are protecting themselves on the transactions that they take. And passive guarantee approaches that you may see in some developed markets will not work in emerging economies because you need to be at the forefront, making sure that all the risks are mitigated, structured, etc. So Garanko has been running for 20 years and it's taken a while to scale, but it has built up the scale now. Its portfolio is over $1 billion and its leverage, which is a key metric, is now over 3 times. That's far below what the monolines and even what Assured Guarantee is doing today, which is around 20 times. But it's on the path to financial sustainability and has been profitable for the last year or two. So we've got this regional strategy through Garanko, but we've also been looking at other strategies to try and increase mobilization. And what we found is where in certain markets where the demand for credit enhancement outstrips the ability for Garanko's appetite to support one particular country, plus the idiosyncrasies between different markets, has led us to look at creating dedicated onshore entities with our partners in different countries in Africa and Asia. And I'm glad you'll hear from Chinwan InfraCredit, which is one of the entities that we worked together with our partners to establish in 2017. But we also helped to establish Tamana and also in Kenya and Infrazom in Pakistan. So, and often we asked, why do you pursue this model as well? Well, actually, we see as an evolution of the Garanko model where we really want to increase the onshore component of solving these issues. And when you establish these entities, which aren't subsidiaries of ours, they are investee companies, which we typically anchor the investment in, but we mobilize other local and regional shareholders into the equity. They're commercial vehicles.
We just ask you to come to a close.
Yeah. And so this mobilization is commercially driven, and we seek to then exit to the private sector, which happened with InfraCredit last year. So with Garanco, we have the offshore strategy. With the domestic entities, they're more onshore, but they work together because Garanco can provide a syndication partner strategy for the onshore entities and also act as an aggregation platform to help access offshore reinsurance and re-guarantee strategies to then mobilize and move risk from the onshore entities across the globe to other entities as well. But I think the key point is I agree with William, the dedicated model is quite key because you have to develop that specific expertise and you need to be able to leverage a balance sheet and you need to be able to maintain a rating, all of which is easier when you have a dedicated platform to work off. Thank you.
Thank you very much, Dinesh. So I've, of course, been excessively optimistic with this timeline. We need to keep it disciplined. And with that, to Lasita Pereira, please. Lasita is the CEO of the Green Guarantee Company. Lasita, we'd be interested in your perspective on the report's findings, and again, in particular on this question of scalability of guarantee solutions, including those of GGC. Over to you.
Thanks, Hans. And I will make sure I stick to the 5 minutes. So the Green Guarantee Company is a specialist climate infrastructure-focused guarantor. We look at mobilizing global capital markets to invest in climate infrastructure in emerging markets. And that's really our focus and our area of specialism. And we've built a team of very experienced individuals that come together to help deliver that on that mission. William, thank you for a very insightful report. It was very interesting to read. I think just some reflections. In the report, you say that you've divorced development impact from the analysis, and I can understand why you've done so, because the monoline insurance industry wasn't set out with a specific mandate to generate development impact. It was, as you put it, a commercial imperative. But I think in the context of considering what sustainability in a guarantor means, you can't divorce those two aspects, because if you are looking to create a guarantor that is going to go in and build new markets from scratch, building on what my colleague Dinesh was saying earlier, then you can't make that a very commercialized. You require a level of subsidy to be able to achieve that mission. Being purely commercial is going to be challenging. And so I think that's something that, as donors consider what guarantors they want to support, they need to create that balance and understand that there is a trade-off if you want to make something very commercial initially, that you then potentially sacrifice development impact in doing so. And I think that's an important nuance that's often missed in when thinking about the construction of a guarantor. Once a market is established, then you can migrate towards becoming very commercial and move on from that perspective. And so, I think that's part of the model that you see, where ultimately, from our perspective, success is driven not simply by the Green Guarantee mobilizing large amounts of capital from the global market at scale, but also when we are able to migrate our capital from being from the public sector predominantly to the private sector predominantly. And that's part of our mission as well, in terms of us demonstrating success in the long run. I also think that an important thing that came out of the report is the cautionary tale that the monoline insurance industry provides us, which is that, it proves the old adage, you should stick to what you know best. If you have invested heavily in creating expertise in a specific asset class, to then start moving into other asset classes with the same team, without actually having made the same investment in terms of actually understanding the new asset class, then ultimately you flirt with disaster, as was proven to be the case. Now, I think this is quite important, because actually what guarantees sell isn't a financial product. We sell confidence, and confidence builds markets. And actually the reverse is true. If you remove confidence, you destroy markets. So it's incumbent on us as specialist guarantors to be really clear about our strategy and our mission and what we're doing, so that and sticking to that, to be ensure that we're creating confidence and maintaining it. And to some degree, this is where rating agencies play an important role in terms of also helping us stay true, true to our true north, if I can put it that way. There is an argument to make that the monoline insurers, they went and guaranteed safe municipal assets and then moved into more risky assets. And ultimately, the credit rating that they had didn't actually reflect the underlying portfolio. We at the Green Guarantee Company have taken a different stance. Our rating reflects the underlying credit risk that we're taking. It's not anchored, unlike some other guarantors, in the strength of our shareholders. And I think this important focus on being very clear, transparent, and direct with the market about what our strategy is very important. And that's been proven by the fact that actually demand for our product is outstripping our current guarantee capacity of $1 billion, and we're actually able to look to expand that. So, so we are, from our perspective, we think this report is very interesting, but there are some important nuances which, if you're a donor looking at this, you need to think about in terms of the trade-offs that I mentioned earlier.
Excellent. Thank you very much, Lasita, also for sticking to the time frame. And I take both Dinesh and Lasita have been emphasizing very much the expertise dimension of this in various ways. So now I would like to turn to Chinua Azubike, is the CEO of InfraCredit. And I have the same questions to you, Chinua, as to the others. And I wonder whether you will also speak to us about expertise.
Thank you, Hans-Peter. It's a pleasure to be here. Again, great report, William and team. I found it very insightful. It brought some very useful perspectives. I think, as Dinesh had mentioned, InfraCredit was set up to address the market failure using a different lens, which is, building local institutions, local capacity, sort of to solve local problems. And I think that approach in terms of having set up a local guarantee company, which essentially was focused on capital market development, reflects some of the themes of the report in terms of, when you do have dedicated local team that is really focused on addressing a particular market failure and building that local capacity. It addresses many constraints that we find in some of the traditional models. So in our experience, we've seen pricing being more efficient. So, one of the challenges in pricing risk is where the lens through which you see risk and perceive risk. As a local operating team, we're able to assess risk better, price risk better, manage risk better. I think one of that reflected in the quality of the guarantee portfolio for InfraCredit over the past 9 years plus. We've had 0 losses on our portfolio to date. And that sort of reflected in, the ability of the institution to actually list, and thanks to Mobilist for the support, very valuable last year when InfraCredit was able to list its shares and attract domestic institutional investors. And I think if I now look at the sort of evolving discussion about the business models, yes, I'd say that, in less developed markets, guarantors tend to play a much more broader role than just, mobilizing capital. There is a broader development role in actually creating markets. And that market creation role cannot be, underemphasized, in the sense that you find that these institutions end up playing a stronger role in building capacity, whether it's with the domestic institutional investors, such as the pension funds, or working with the actual underlying potential clients to make them understand better why they should use guarantees. So that role requires additional, I'd say, resources, especially at the market creation stage. But something unique happened in Nigeria last year. Our Securities and Exchange Commission has put in a regulation for guarantee credit enhancement facility providers in the capital markets. I think that has a very interesting dynamic if you look into the future in terms of what this means for capital market operators. Potentially, what I see is that you're going to have more players like InfraCredit operating in the domestic debt capital market, de-risking, infrastructure bond issuances, and we're probably seeing a transition into a more market-led sort of, business model for mobilizing domestic capital for domestic institutional investors using guarantees. So it's interesting because I think the sort of transition and maturity that the organization has demonstrated, and possibly the effect of seeing more organizations getting licensed to do what we do, could actually create a new market in terms of just the financial system for credit guarantees in deepening capital markets. Um, I'd comment on just a bit around the reinsurance. So I think there's a very interesting correlation between the margin, the sort of tight margin you see in guarantees versus rating versus scale. And how do you use sort of re-guarantees, reinsurance, risk-sharing models to lessen the cost of capital? Because what we've seen is that equity is obviously more expensive than re-guarantees or reinsurance models. So, that model will be very interesting when it begins to strengthen capacity of especially local guarantors to operate at scale. We've successfully worked with AFBB, Garanco itself, at TD, recently BII, in providing risk sharing. We found that very valuable in managing risk for our guarantee capacity. And we also see, an opportunity where, as the market begins to explore how scaling can be done, market fit in terms of, focusing on specific market segments are key. So we've had to build out a dedicated team for renewable energy. And through that process, we found very interestingly that it's critical to build local capacity that specialists are tied to certain markets, given the nuances of these markets and actually the ecosystem challenges that we tend to face in less developed markets when you're addressing these failures. So I do agree that, in terms of products and building specialist teams is very key. And that in itself drives the conversation around institutional culture. You can both come together in strengthening the capacity of these business models to improve markets, in terms of scale. So all in all, I think the report has been quite insightful for us. We find it very helpful in actually looking at strategy for the industry going forward. And even for us, being able to look at what are the lessons learned and the better approaches to take in the future. So thanks. It's a pleasure to be here.
Thank you very much, Chinua, and thank you all. I think this has been, you've given a lot of additional depth to this report by William. I take in particular this repeat point about the expertise, the market-specific knowledge. You now added, Chinua, the sector expertise that need to be added. Now, with that, I'd like to turn to our panel. And there, I'd like to start with Ed Mountfield, and a question to Ed. Ed Mountfield is the Vice President for Finance, Risk, Economics, and Sustainability at MIGA, the Multilateral Investment Guarantee Agency. Now, Ed, first, perhaps a very general question from MIGA's perspective. As of today, what kinds of risks are guarantees most effective at mitigating, and where are there gaps in your view?
Thanks, Hans Peter, and thanks to William and everybody for really, really interesting comments and insights. So just to start off at the World Bank Group, we are not skeptical about guarantees in the slightest. In fact, we're evangelists for guarantees, I would say, increasingly. In a time of scarce development finance, we think they are an extraordinary value proposition for taxpayers, and MIGA is growing its business very rapidly. In a few weeks' time, we will issue our 100th billionth dollar of cumulative guarantees issuance, and all of that has been done with only $366 million of capital ever paid in by our shareholders, in large part because we are able to seed about 70% of our gross exposure to the insurance markets around the world. Whether we're guaranteeing credits or trade finance or political risks like breach of contract, expropriation, currency transfer and convertibility, war and civil disturbance, we facilitate foreign direct investment into countries that need it, often for transformational investments. We think that our guarantees help very often to lower the price that the lender would charge our client or provide a longer tenor than they would otherwise. But many times we're also supporting a client to go into a completely new country, region, or sector where they're less familiar with the political environment. So a particular advantage that we think we have as a guarantee agency within the World Bank Group is that we can draw on our specialist on the ground knowledge as the World Bank Group of these country and sector contexts. So we will often assess the risks to be lower than others do. And in that sense, we can take a bet against our guarantee holders about the risks being lower than they think they are. And even where the risks really are high, a special power of MIGA as a guarantee agency within the World Bank Group is that we have a particularly close relationship with the sovereign. We've only ever had to pay 12 claims in 38 years, and that's not because we don't take risks or because we don't face frequent challenges and pre-claim situations, but because we manage and solve them for our clients before they materialize. And by being able to pick up the phone to ministers of finance, central bank governors, heads of state, as part of the World Bank Group and serve as an honest broker, we're usually able to solve problems before they become claims. So where are the gaps? There are many, and MIGA is working all the time to fill them, but we also really value the agility and innovation that comes from some of the specialist guarantee groups on the call today. A number of years ago, for example, MIGA saw that global banks were constrained from investing in emerging markets because they had to hold so much regulatory capital within central banks against their exposures. So a few years ago, we launched our capital optimization product, which provides bank regulatory relief using guarantees that can be freed up to allow scaled up and developmentally purposed lending into the local economy. Later, we saw that many countries, especially in Africa, had a lack of access to trade finance. So in the last few years, we've launched our trade finance guarantee product. Similarly, we recognized the need to provide credit guarantees to more countries in the past that wouldn't have been eligible. So we've developed risk-sharing arrangements with IDA and IBRD, which allow us to offer guarantees in many more countries using first loss, second loss structures. But still gaps remain, and maybe there's a few I'd just quickly highlight before I close. First, there is a gap in terms of the regulatory and the operating environment in many countries, and when the operating environment is too challenging or the regulatory framework is too uncertain, projects run the risk of not being commercially viable, and no amount of political risk insurance can overcome that. So that's why we're working closely with our colleagues as part of the World Bank Group and with other MDBs to help improve the investment landscape. Second, I'd highlight natural catastrophe insurance. Wherever you go in the developing world, you see countries on the front line of a climate emergency, but catastrophe insurance for these countries is still very nascent and often too expensive. So MIGA has a very close relationship with the global insurance industry, and because we have close to $30 billion of risks indicated to reinsurance partners. So we're also working with them to see how we could close protection gaps. And then I think local currency guarantees, clearly an area where there's important work to be done by all of us. And we are taking steps in that area ourselves as MIGA, as well as using our transfer and convertibility product, which is very powerful. But there's very interesting work that many of the boutique guarantee partners are doing to develop new approaches in that field. Let me stop there.
Excellent. Thank you, Ed. And there's so much here. I hope we'll have the time to come back to some of these issues, but now I'd like to ask for a different perspective from Katrin Mühlbronner. Katrin is the Senior Vice President at Moody's Investors Service, responsible for supranationals. And Katrin, so you rate several of the guarantee providers that are mentioned in William's report and that are present here. Can you give us a sense of the factors that are determining these ratings?
Yeah, thanks, Hans-Peter. Nice to see some of you. We have been in contact in different environments before, but yeah, William, congratulations on the paper. This is very, very useful. And Hans-Peter, yes, you're right. We rate 4 guarantee providers, all of which have been set up by governments and MDBs and DFIs and are active in emerging markets. Garantco was already mentioned a few times. We rated at A1. That's the A+ equivalent that we use at Moody's. TD, the African Trade and Investment Development Insurance, that's an A2. The Islamic Corporation for the Insurance of Investment and Export Credit, I will call it Islamic because it's such a mouthful of a name, is a AA3. And we have a relatively new rating, which is an Africa-focused entity, the African Solidarity Fund, active in West Africa. That's a Baa1. So all of them investment grade. All of these ratings are global ratings, so not national scale or so. So they are comparable to the AAA for the World Bank or the EIB, same scale. We do rate them under different methodologies, which I think is interesting. So I look at the ones that are rated under as MDBs, Garantco and the African Solidarity Fund. The other 2 are TD and the Islamic. We rate as financial guarantors. Still, you do come out with similar ratings. Bear in mind that the ratings, the A2 for our TD and the AA3 for the Islamic are insurance financial strength ratings. So they speak to the ability to pay insurance claims. And those are typically 1 or 2 notches above a senior debt rating. But, different methodologies, but same ratings, all investment grade. So there clearly is a possibility to establish a niche or boutique guarantor with a sufficiently high rating. I think William makes a good point. There is big variation if you look at the gross exposures. Garantco, as Dinesh was saying, is a bit over 1 billion. The African Solidarity Fund is 500 million or 600 million in size, and the other 2 are much, much larger. I looked up the numbers on the public websites. TD is 9 billion, Islamic is 13 billion in gross exposure. And that also speaks to a point that has been made quite a bit already. Reinsurance is important. Clearly, if I look at it, that has allowed the RTD and Islamics to have much, much bigger portfolios because they do cede a very large share to reinsurance. If I look on a net basis, Garantco, the way we define it, has a leverage of about 2.5 times, 2.5 times. RTD's leverage on a net basis is lower, 1.4. Islamics is higher, about 4. But it also has a much stronger asset quality. That's no comparison to assured guarantee that William also mentioned. I think leverage there is about 24 times, but clearly assured has a very different portfolio, very different credit quality of its portfolio. So reinsurance, I think I can confirm is an important factor. For us, or what I've thought is interesting, certainly in the analysis that we do for RTD and Islamic, we explicitly assume preferred creditor treatment. So that's an important support for the quality of their asset. And they have in their statutes explicitly a line that recognizes them as preferred creditors. Their shareholders are also the main beneficiaries of their activity, so that's certainly one of the reasons why it's there. And it hasn't historically, I think, held in every case. It is an important support for their asset quality, which is an important factor we look at. We don't assume that Garantco or the African Solidarity Fund are preferred creditors in our assessment. What are the other factors that we look at? Shareholder support. That's, of course, particularly important for entities that are not yet financially self-sustaining. Certainly, when we look at an entity rated as an MDB, if we have an entity where you have persistent losses, that does raise or could raise questions about the long-term viability of the business model. Ultimately, how committed are shareholders? How long are they willing to put in more money? Garantco has been mentioned a few times, and we've been rating Garantco since 2014. We've maintained an A1 rating ever since. We've never changed it. And I think strong shareholder support has been a very important aspect to that.
Catherine.
We need to end.
Yeah, we'll come back
Yeah.
on some of these
That's
issues.
fine.
But maybe right now we could just move on, and we're hopelessly, beyond our time at this point to eventually have to make hard choices. But I did want so now to turn to Hassatu. Hassatu Diop-Nsele is the Vice President Finance and CFO of the African Development Bank Group. Thank you for being with us, Hassatu. Now, from the standpoint of an MDB, and you've heard Ed making a strong case a very optimistic case for guarantees. You have those instruments. What role do guarantees play in your toolkit? What are the criteria that guide the choices that you make?
Thank you very much, Hans, and thanks to you and ODI for having the African Development Bank here as part of this panel, and also very warm thanks to William for this for the research bit that he's provided. For the African Development Bank, guarantees is very important because basically guarantees, in our view, is a powerful tool and one of the key instruments to attain Africa's development. This is one of the reasons why the African Development Bank is a shareholder of ATD, is a shareholder of Afra Credit, but also a shareholder of the AGF. So from our standpoint, it is about additionality, it is about cost, it is about client needs, and also about capital mobilization. So rather than begin with the instrument, we begin with the development objectives and we ask ourselves, what is the need of our clients? What it is that we need to solve for? What is the gap that we need to address? How can we reduce the transaction costs for our clients? And what's the most effective way to unlock the private capital required to achieve it? So our guarantee product offerings includes local currency guarantees, tenor extension, political risk, non-payment derivatives, portfolio guarantees, and so forth for our clients who need risk mitigation solutions. And there are 4 core criteria that guide our choice. The first is market failure, as we talked about. Many investors have a perception of high risk in Africa, and they require additional premium compared to other regions in the world. And this has an impact both on the amount of capital that Africa is able to attract, but also on the cost of projects. So guarantees are particularly powerful where viable projects exist, but private financiers are constrained by specific risk. So our guarantees address this higher risk perception by covering the risk that the market is not able to bear. And the second criterion is the pricing and market access. We have advantageous pricing, but also guarantees can significantly reduce total financing cost and improve the financing term while at the same time bringing new sources of financing into the projects. And the third criteria is capital mobilization, and that is key. Guarantees allows us to leverage the African Development Bank Group's headroom for a specific country and mobilize multiple units of private capital for the development of the continent. And last but not least, there is the sustainability and demonstration effects. So in some markets, particularly across Africa, our objective is both to close the transaction, but as well as to build confidence in an entire asset class. So a well-structured guaranteed asset can help establish track records in many market segments, SME, lending, infrastructure, but also in the capital markets, allowing clients to eventually stand on their own. So in summary, we deploy guarantees when they are the most efficient tools to crowd in private capital, when they preserve scarce MDB capital for higher risk frontier needs and when they strengthen rather than substitute for domestic financial system. But we do remain disciplined. The MDB balance sheet, the multilateral balance sheet, is a public trust. So every instrument, be it a loan, whether concessional or non-concessional, trade finance, equity, or guarantee, must justify its use, not only in developmental terms, but also in terms of financial resilience. So that discipline is what allows MDBs to scale responsibly, especially in a world where demands, on our capital continue to grow.
Thank you very much, Hasatu. And again, I see this very optimistic take on guarantees as a instrument that can be scaled. And if I come back to that question with you, Ed, around this issue of scaling, what are key features of guarantees that are most important for scale from your perspective? And maybe you could also comment in that context on these specialist guarantee companies. To what extent are you a specialist guarantee company? To what extent do you see a place for specialist companies like the monolines that William has been writing about?
Thanks, Hans-Peter. So at MIGA, as the World Bank Group's guarantee platform, we're scaling our guarantee issuance very rapidly. This year, we're very much on track to deliver about $14 billion of new issuance. And by 2030, our target is to be issuing at least $20 billion a year, and I think quite likely more than that. So to scale our guarantees, a few things are important. One, efficiency is critical. In the past, we would primarily underwrite individual guarantees, which could be quite cumbersome and slow with often small tickets. Increasingly, we are approving portfolios of guarantees, sometimes as large as $1.5 billion at a time, brought to us by clients investing in multiple projects rather than approving guarantees on an individual basis. And this works well when we work with our long-term clients who already adhere to best-in-class environmental and social standards and due diligence and reporting requirements. And it also really helps us in syndicating our risk in insurance markets because they get to see a much more standardized class of investments. Second, partnership with the wider World Bank Group has been key. 2 years ago, we took the decision to unify under MIGA the specialist guarantee products being offered across the World Bank Group by MIGA, IBID, IDA, and IFC. So we can now underwrite on 4 different balance sheets. And this unified approach has opened the door to innovation and more efficient risk structuring, for example, first loss, second loss structures across balance sheets. It's also created administrative efficiencies, but above all, it's streamlined the client experience so that they no longer have to talk to the beast with 4 different heads, but they can come to one place and find a solution. We're also expanding our efforts to partner with MDBs and donors to share risks. We see significant opportunities to work with those who have more regional expertise than we do. And for example, we're exploring risk shifts where MDBs do the initial underwriting and due diligence, and we provide, as MIGA, a guarantee on some of the portfolio, freeing up space for MDBs to lend more. So as to specialist guarantee companies, I guess I'll give a kind of on the one hand, on the other hand answer. As the number of guarantee companies grow, there's obviously a risk of fragmentation, which we've seen in the wider ODA landscape over the last few decades. As I noted earlier, that there are huge efficiencies and effectiveness benefits to working at scale, to working within a broader MDB with all the expertise and the risk halo that brings. And for that reason, the World Bank Group's actually going almost in the opposite direction of integrating our guarantee offerings across rather than having the fragmentation of our different products. And I guess also for that reason, successive expert reports from the G20 have called for MIGA to be enhanced as a guarantee agency for the international system in a sense. But at the same time, I think we very much recognize that there are enormous needs the World Bank Group, the African Development Bank can't begin to fill these needs on their own. There's very definitely space for boutique guarantee providers if they have specialist sectoral or geographical expertise or reach and presence, and with the strong support of their shareholders. Amiga works all the time as a partner with other guarantee providers, and working with partners can help us to optimize risk, to build new opportunities together. And we have an open door and open ears all the time for all partners.
Thank you. Thank you very much. Interesting to hear your point about fragmentation. It's of course quite important if we look sort of forward as to what the MDBs might do in that space. And I note Chinua's point earlier about the benefits of competition in Nigeria, bringing down margins and developing expertise. So it's kind of interesting tension there. But Catherine, can I come back to you, please? So if you look at this from your perspective, how do you view transactions that benefit from a guarantee by these institutions, and what is a capital efficient way of deploying development finance to mitigate risks?
Yeah, thanks. I think there is a lot happening in this space that we're not really part of because we have seen, I think, in emerging markets a relatively limited number of transactions that asked for a rating, where MIGA or a DFI or an MDB comes in providing guarantee. These transactions typically want to achieve an investment grade rating. That's also what we have been rating, but certainly the transactions that we have seen have been very bespoke, tailor-made. So, in terms of scalability and standardization, that doesn't look like the right way to go. Of course, we know that MDBs, like Hasatu was saying, do extend a lot of guarantees for us. We treat them, if we look at the MDBs, in the same way as a loan or an equity investment would be looked at. But we've also seen some transactions where MDBs provide guarantees for bond issuances. A full guarantee, I think, is not a very capital efficient way. Yes, you get up to a potentially AAA rating, but is that really what's required? What we've seen in a few instances are partial guarantees on emerging market government bonds. A few years ago, Ghana issued a bond with an IDA guarantee. Those typically get uplift of 2 to 3 notches. So unless you are already or you're providing this type of guarantee to a borrower with a relatively high rating, that doesn't get you to an investment grade rating. So the Ghana bond that I just mentioned, that was had a 40% IDA guarantee, was rated B1 when Ghana was rated B3. So a bit of uplift, but not that much.
Okay, thanks, Katrin, and thanks for being brief. Now we have a last point, and I think that's Hasatu, kind of important one, because I would like to ask you to draw a bit on what you've heard and tell us about the African Development Bank's strategy in this space. What role do guarantee companies play in your strategy going forward?
So we see is that we see guarantee as adding the greatest development value in 3 specific areas in terms of infrastructure and energy in the context of the African Development Bank. In terms of energy transition, SMEs and trade finance, but also local currency capital markets. And so as you know, in terms of infrastructure and energy transition, Africa faces the long-term financing gaps, and projects are often commercially viable, but private financiers are constrained by political risk, they're constrained by regulatory risk, they're constrained by currency risk, and the guarantees can reduce perceived risk sufficiently to crowding institutional investors and commercial banks, particularly for longer maturities that the domestic market is not in a position to provide. SMEs, same story, the partial credit guarantees and portfolio risk sharing, for example, unlock local bank lending at scale. So here, guarantees are more than simply a transaction tool. However, they are market deepening instrument that strengthen domestic financial systems. With regards to local currency capital markets, severely underdeveloped across the continent, you cannot have sustainable development without functioning local currency capital markets. And developing domestic bond markets is essential, for financial sovereignty and also resilience. So guarantees also here can play a role because they help establish benchmark issuances and attract new classes of investors. So many things that we're looking at and how we're building that up, through various means. We look at we structure instruments in the way that it maximizes mobilization ratios. So that is very important. We need to ensure that each unit of MDB risk is able to crowd in multiple units of private capital. It's about deepening partnership with insurers, with co-guarantors, with institutional investors, local banks, to distribute risk across the system rather than concentrate it. And to the question on on these specialist guarantees and how we cooperate with them, so we view them as important partners within a clear framework. And actually, we're working on a Pan-African guarantee platform, which is considering these questions. And the consultations that we were able to have with various stakeholders is that Africa doesn't, what Africa lacks is a system that operates cohesively, predictably, and at sufficient scale. The credit protection landscape that we have include capable MDBs, DFIs, regional and international guarantors, ECAs, and private insurers. Yet, from the perspective of capital providers, engagement remains fragmented. So coverage terms vary, documentation differs, and assembling sufficient risk mitigation often requires negotiating separately with multiple institutions. And it creates complexity in terms of increases execution risk, but also it limits investors' ability to deploy the capital programmatically. So there is a need for greater coherence, and there is a need for our specialist guarantee companies with strong governance, sound capitalization, and proven underwriting capacity, which is totally aligned with the findings of William's research. And they can complement MDBs by operating closer to local markets and scaling specific segments such as SMEs or portfolio guarantee. So the Pan-African guarantee that we're looking at is, it's not yet to create another institution, but it's looking at the gap, and it's about unifying rather than fragmenting. And it will simplify market access for investors and preserves and leverage the balance sheet capacity of existing institutions. So we're guided by additionality, we're guided by sustainability. The business model must withstand stress and avoid reliance over reliance on concessional support, and there needs to be system integrity. So as I said earlier, guarantees most powerful when deployed as part of a coherent portfolio strategy. And it can build markets in Africa, it can mobilize private sector at scale, and preserve the resilience of the multilateral system.
Brilliant. Thank you, Hassatu. I take it very interesting, the point you make about creating a platform. So that somewhere it's about transparency, it's about allowing market players to find each other and therefore also find what the value of particular guarantee operations is. So this was all really very useful. We have now a few minutes left for our Q&A and already have a few questions. I don't know if you have access. There was one question for Ed on Basel III, the treatment of MDB partial risk guarantees in particular, including in MDB blended finance structures. So what's your take on that? What's your experience with that? Is that a problem? We have a question from Stefano Capodali. The first one was from Sam Attridge. We have a question by Stefano Capodali, and that is to Catherine about treatment of trade finance guarantees, which are short-term, and to what extent that provides sort of a different kind of considerations. So those are 2 points that we have here. I would then also like to give William a couple of minutes perhaps to react to some of the points that he's heard, but we're monitoring the Q&A. So please, Ed.
Thanks. Well, just very briefly, because I know we're running short of time. The Basel Committee recognizes MIGA as part of the World Bank Group, a highly rated MDB, and for that reason, the guarantee holders that take our non-honoring products are able essentially to zero rate those out. So this is a powerful advantage as well of a guarantee agency within an MDB. Maybe I'll just stop there and happy to follow up bilaterally on that. And just to apologize, I'm afraid I'm going to have to jump off sharply at 1:30, but look forward to watching the rest on the catch up.
Yeah. Thank you, Ed, and also thanks for your offer of following up. We have 100 and something participants who will be eager to hear that. Catherine, please.
Yeah, very, very briefly. I mean, in our metrics, we don't distinguish between trade finance guarantees and others, but we do look at the impact on liquidity and so on. So short-term trade finance is certainly something that we do take into account in a qualitative fashion. But in terms of in quantitative metrics, we treat them similar to others.
Okay, Catherine, that was concise. And William, before coming to you, there's one more question here by Paula Rodriguez, who is working on is a structured finance lawyer. And the question is to Ed before you jump off. So I don't know if you've seen it in markets like Brazil, where domestic banks and development institutions are already quite active in infrastructure finance. How does MIGA approach the structuring of its debt guarantee products to ensure genuine additionality rather than substituting for financing otherwise available? So the additionality question.
So MIGA's convention mandates us to support foreign direct investment, but we are very often able to support the local private sector through application of a number of our instruments. So I mentioned already the capital optimization product, which allows subsidiaries of international banks to manage their regulatory capital in a more efficient way. We also provide non-honoring guarantees to state-owned commercial banks. That's an important part of our business. And of course, they then provide financing in local currency to businesses, frequently MSME businesses inside the country. Of course, there's always a question about additionality, and we manage that very closely through tight use of proceeds by making sure that we see incremental business in the country and not just substituting one form of risk management within a balance sheet for another. And we have regular reporting from our guarantee holders about the use of proceeds. We also publish the incremental development impacts as part of the World Bank Group scorecard, and pay very close attention to the impact of our guarantees, both in terms of the direct effects of the project itself, but also in terms of its role in creating markets and helping to build more channels for foreign direct investment. But I mean, it's a very important question about managing that additionality, and something we take very seriously at MIGA.
Great. Thank you very much, Ed. I'm going to skip my concluding remarks because I think you've been all very clear, and better want to give a couple of minutes to William. And if others, please, Hasatu, Chinua, Dinesh, Lasita, if you have any issues, or Ross, please lift your hand if you want to come in. William, any reactions to what you've heard?
So massively interesting comments from everybody, including the development banks and Catherine from Moody's and the various guarantee companies. So Really interesting comments. I mean, I'd just like to emphasize again that, we could have written a paper about the instrument, the way it's used, but we're not here. We're talking about the organizations. So my paper is almost like a corporate finance paper in the underlying themes of it. And so there are a couple of big things we leave out. We don't, which I thought, there were very sensible comments on market development, so important. So such a big topic, but don't really reflect on that here because we're coming from what lessons can you get from the monolines, but the way in which different entities affect, not just guarantees, but who does the guarantee? How is it done? How does that then affect market development? Sustainability, massively important, but we're here focusing on what? Well, we're focusing on financial organizations, sustainability, scaling. So the paper is one of the few things I've seen in all of these papers in the area that focuses on the dirty word, return on equity. So why would you not have a return on equity? Look at the World Bank. How much of its capital is paid in? Very little. These organizations have built up businesses over many years through surpluses. And so return on equity, an important thing in considering these organizations. And so I've been trying to think about the financial organizations, the constraints on them, how can they build their businesses with the ultimate objective of helping development, helping sustainability, helping impact. But before you get there, you have to worry about a sustainable organization that can continue and not simply take resources from donors, but ultimately is going to be bringing in equity from the private sector and building scale for the long term. Okay.
Now, excellent, William, and we're kind of on the dot here. There are sort of topics that have run across this discussion that you had already pointed to, William, in your report. I want to come back to this question of the expertise as a value-adding factor for this industry in a way which was really quite interesting. The point about being able to aggregate the risks, being able to go into specialist markets. We've heard sort of the very positive message from the MDBs, from Hasatu and from Ed, who is both an MDB and a specialist agency, that guarantees will play a much bigger role going forward. And from Hasatu in particular, also this message that these specialist guarantee companies in which AFDB has invested should be playing a role in the strategy going forward. And of course, we've all learned quite a bit about your companies, which I expect to play a much bigger role in the development finance debate going forward for all the good reasons that we've heard here today. And Catherine, you and Moody's, you are going to bless the growth of this market because you see that it is well handled, that there's a lot of confidence that these institutions are building. So thank you. Ross, I see you coming back. Did you want to have sort of a last closing observation? But from me, and I think from everybody here, a big thank you to you, to UK, to the Swiss government, Mobilist, for having sponsored this. And in fact, just a couple of weeks ago, we had another discussion about secondary markets. It's great that you're sponsoring these discussions about subjects that are not so familiar in the development finance community, but that can really play an increasingly important role. We have to look across all the instruments that we have. There's a big task at hand. With that, thank you very much, everyone. This was a very instructive conversation, and thank you, William, for this great report that you've given us. Bye-bye.
Thank you. Bye-bye.